Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Rupert West of Puma Investments to talk about the Puma VCTs. Hello Rupert, welcome back to the studio. So we're here to talk about the Puma 13 VCT and the Puma Alpha VCT. So for those who don't know, what are they, what makes them different, and why should investors consider them?
Yeah, so our VCTs are a bit different. They're not about taking exposure to lots and lots of little companies and sort of hoping that you get a couple of breakthroughs. They're about larger rounds into slightly more established companies that we can really work very closely with, and we lean in, give them a lot of support and kind of stay very close to them, deep relationships through our period of hold. So, for example, when we're investing into a company, that company will then have a session with our value creation team to start really turning their strategy into an implementable plan that all of the management team are aligned around and that we're aligned around. They'll then get a whole load of work from our finance lead on their KPIs that build out of their finance team. They'll work with people from our people team on their sort of employee offer and their organic structure that they're looking to put together as they grow, and then they'll get some extra help with the sales team and various other aspects. So it's quite a sort of involved process, and therefore we do that very deep into fewer companies, backing them with a larger amount of money that they can really drive some strategic growth with.
And any differences between the two VCTs?
No, so our two VCTs run the same strategy and in fact co-invest quite a lot. It's just that one is a few years behind the other. It's a bit smaller, and they're there as to be available to investors who might be coming out of one, but really still want to retain exposure to all of the same companies and the same investment style. They could come into the other.
And so Rupert, for people who aren't familiar, Puma Investments, who are Puma Investments and what's your role there?
So Puma is a company that was set up 12 years ago, and it's grown to now be about $1 billion of AUM, run by about 100 people that we have in-house. We put ourselves together, so our founder and CEO, David Kay, built the company to be very rigorous around the things that we do. We haven't expanded terribly broadly in terms of what we do. We are still very focused on lending to property, equity to small companies, and some listed equities work on the AIM market. So we get deep into that with serious teams and look to be very rigorous around those operations. But on top of that, we've built quite a big customer service and investor relations function, and we take quite seriously the job of communicating well with our investors, giving them good materials, giving them clarity about kind of what's going on. And we also, within within that number of people, so within the 100, we have pretty deep internal functions of finance, compliance, legal, that we use to support our own operations, but also to support the portfolio companies that we back within the VCTs.
And that's grown pretty strongly, isn't it, in recent years?
Yeah, we've certainly continued to grow the platform, both in terms of the personnel and skill set, also the money that we've raised. We've expanded into Manchester and more recently into Edinburgh, and that's to really give us sort of deal reach in those regions. They're quite good local markets. We're not there to tread on toes. We're there to sort of add some additional funding into the ecosystem, and we find great people into those locations to help us support companies on the ground there.
And so turning back to the VCTs, what sort of companies are you looking to back? And are you more of a generalist investor or a sector specialist?
So we're really to be thought of as a stage specialist rather than a sector specialist. So we are across a lot of sectors, and we actually really value that, but we're quite specific on the nature of the company that we're looking for, which is we broadly badge as scale up rather than start up. So we're looking for businesses that have now got quite a lot of commercial data about their sales structure and who they're having success with. So we're looking for businesses that are getting pretty clear on their ideal customer profile and have enough information and data that all of those people and resources that I mentioned that sit at the Puma side actually have something to work with and kind of get their teeth stuck into. So we've got quite a specific view of the kind of company that can get the most benefit from us, and therefore the type of company that we go for. And in parallel with all of that, we're looking for businesses that they hold quite a disruptive, innovative solution or product, but they're selling into a big established market. So we're not trying to change buyer behavior and convince them that they have some problem they didn't think they had before. We're really looking for companies that sell in with a better version of product, but to sell into a big established buyer set.
And in terms of revenues, what sort of revenue?
So that is something that will vary by sector and business model. For example, when we look at consumer businesses, which we sometimes do, we really only look at sort of 7 million plus in terms of revenue, whereas for a fast growth SaaS business, that would be a bit smaller. So it's not a hard and fast rule because it's built to fit the different sectors.
Okay, but strong evidence of traction, I guess,
Right.
kind of differentiates you. Okay. And so looking at some of the more recent investments in the VCT, do you have any examples there?
Yeah, I guess actually our most recent investment sort of ties up some of those themes. So this was it's a regulatory focused fintech business in Scotland. So it came about at the sort of similar time that we were opening the office in Scotland, and was the culmination of a few years of having been looking at that market and kind of deepening our ecosystem up there. And so we've led the largest Series A in Scotland for this year into this company Veni, which uses AI and clever technology, but uses AI to help IFAs, so wealth managers, meet their compliance needs in a much more effective and efficient way, so that it steps them up and really is looking to support their compliance teams to be scalable and meet best in practice needs for compliant obligations. So this is a business that, when we talk about that commercial traction, this was already selling into some of the largest wealth management firms in the UK, and coming in on this round, so this was an 11 million round, so it gives them some real firepower to pursue a strategic plan. We've come in alongside Nationwide and Lloyds. So that is the real sort of sector data and expertise, and we're providing the scale-up expertise. So quite a good example, actually, of a sort of Puma-style deal.
Ah, very good. Any other examples?
Well, actually, to kind of discuss and keep that theme of the sort of sector split, another fairly recent deal for us is Lucky Saint, which is non-alcoholic beer, the leading independent non-alcoholic beer in the UK. So very different business, but actually quite similar themes in that this is a professionally run business that's very serious about pursuing a tight, rigorous strategy with a targeted customer set. And their product, if you like, is the differentiation. It is a better quality offering of a non-alcoholic beer, but they're selling into a big established market. So we kind of got comfortable with those two very different businesses, because in our way of thinking about the world, those are both companies that fit the Puma model quite well.
And so how do you find these deals? And then perhaps more importantly, how do you win these deals? And is there anything about Puma now that really sort of helps you win some of these deals?
Yeah, I mean, it's helpful to be in the multiple geographies, so London, Manchester, Edinburgh, and we have been doing this some time. We've built up a reasonably large team. All of that network effect is helpful, but really, actually, I think it's about having that quite precise view of what we're looking for, so that for companies that are the right fit for us, I think our offer is very appealing, and our proposal of very close involvement and ongoing support and a real sort of relationship, and we see partners for growth of these businesses. For the right company, that really chimes, and they really want to work with us. And for companies that don't fit that mold, actually, we wouldn't really be the suitable partner for anyway.
And so, looking at the Puma portfolio and looking at some of the more established holdings, any particular highlights there? Anything that stands out? Any examples?
Well, we've actually just released interim results for the two VCTs. It's just the sort of normal schedule, and it's really nice to see a sort of small incremental lift in the NAV in the interims, and that's actually coming both from the qualifying portfolio and from non-qualifying. I guess if I was to look into the drivers of that positive movement, still quite a strong theme is the US, the strength of the US economy. So companies of ours that are more established in their journey into the US expansion have performed sort of particularly well. So you asked about more mature holdings, and for us, because expanding into new geographies is a reasonably typical part of the growth plan, it does tend to be the companies that have been in our portfolio for longer, are further on that journey. So companies like Influencer and Cameramatic. So Influencer is now the largest independent influencer marketing agency in the world. It's a big business. And always the vision for that was that it would expand into the US. We held back some years, a little bit because of where the business was and sort of readiness, and also because of COVID and the various sort of turbulence. But when the business then did expand physically into the US and open offices there, and the CEO spent a lot of time, and we've built a really good team there, the pace of growth out in the US is really, really impressive. So that's great. Another example of that is Cameramatic. So this is a business that is fleet management software. So for businesses that are running a large mix of lorries and vans, and they might be delivering aggregates or packages and working in sectors that sort of do that. That's where the business started, and again had just a great solution to deliver that. But it's now moved into AI-driven safety and accident prevention. So it's sort of, if we envisage these things that we now get in cars when it beeps at you if you're moving your head too much, these do that for big lorries and trucks in a way that's really quite sophisticated and prevents accidents, which is really about preventing insurance claim risk for these large companies.
And so when you back these companies, to what extent are you getting involved and helping them besides the capital?
Well, sort of, I guess as we've been touching on, that's sort of a big part of our approach, our kind of thesis. So that doesn't stop. So the sort of that involvement level is really our normal practice of interacting with companies. But by way of an example, one of the companies in our portfolio that we've only invested in for just over a year now is a business called Pocket, which is a fintech serving the underbanked, so sort of lower income transitory workers who might struggle or just not find it convenient to access traditional banking otherwise. And these are quick, easy digital solutions that allow them to sort of integrate with digital finance. And that is a business that we've worked extremely closely with over that year to work on its growth, work on its strategy, and then more latterly focus on some aggregation within that sector. And it's recently been announced that business has agreed terms to acquire a much larger rival, Monese, which is about 3 times the size. That deal is still subject to FCA approval, but assuming that it goes ahead as we expect it will, that's an example where we have been hand in hand with management through the strategy of doing this, the funding of the deal, and the integration. So really sort of, I suppose, to kind of what does that mean? That's 2 members of the Puma team allocating a very considerable portion of their time producing guidelines on integration, going and having management meetings, sitting in senior leadership team meetings with that business, meeting the staff on the other side, planning the integration, working through the different steps that are needed, and leading on the sort of key hires that are needed to take that forward.
So a fairly hands-on approach, and therefore perhaps a more reasonably concentrated portfolio as a result.
Yeah, so we will always be more concentrated. It's the nature of all of these things I'm talking about. That sort of to drive that depth of relationship will require a more concentrated portfolio to sort of do that on. Yeah. But that's our view of how to maximize the probability of success for any position and sort of minimize the risk of failure.
Makes sense. And so turning to exits, I think over the past couple of years, it's been a pretty challenging time for venture capital in general. Not too many exits around. Have you had any exits in your portfolio?
Yes, we have exited a few things, but not VCT positions, so sort of elsewhere in the funds that we look after. Yeah, it's been a very light market for exits because really the listed equities markets have not been functional, and bigger funds have really been under pressure to exit their own positions, so have not really been looking to acquire more until they can raise their next fund. And there's a lot of pressure on them that fundraising will not be forthcoming until they can return some money from under funds. So I think depending on sort of who you are and how you run money, that is or isn't much more of a problem. The one benefit for us is that we're pretty familiar with working with our companies for an extended period of hold, and some of our companies are of a reasonable size. So we're not super reliant in our investment strategy of putting a round in and then someone coming in quickly on top of us, such that when that market breaks down a bit, it causes a great deal of problems. I think there are indications that the exit market, the transactional market generally, is beginning to pick up, but that will take a bit of time.
And so turning to risks, how risky would you say are your VCTs, and how do you describe the risks to investors?
So I think our funds should be thought of as risky investments, of course, as should all. And why is that? Well, it's because we are investing into in private illiquid positions into smaller companies, but we work pretty hard to mitigate that to the best extent we can. And how do we do that? Well, the first is really quite tight scrutiny and monitoring of these positions. So there is all of the supportive apparatus that I've kind of talked about, but underpinning that is we have a huge flow of information from our companies. So in part, that's because they are that little bit bigger and have a good finance function and have some FP&A, so can produce that data and sort of have it to hand. But we put that into a sort of a cloud-based portfolio monitoring software system that we use, and that gives us kind of real-time data on a big array of metrics that we can look at. So monitoring is one thing, and that data is looked after by our portfolio finance lead, who has had 20 plus years of experience in PwC and then mid-market private equity. But the second aspect that I think is, or we consider to be very important, is that we are well diversified by sector and business model. So we are not overly exposed to whatever sort of hidden dependency is behind one certain sector. So a sector might either valuations might move in tandem for pretty much every company in that sector, which can leave you very exposed, or there will be a supplier to the bulk of that sector, like when Silicon Valley Bank got into trouble. They were a huge counterparty to the tech sector. And if you were overexposed to that sector, you actually were very highly exposed to that bank. And we try to protect against that by being well diversified across sector.
And we touched on earlier the tougher environment for exits and venture capital as a whole. But turning to the environment today, how are you finding the market today, and where are the opportunities?
Yeah, so essentially this year's been quite light for deployment amongst VCTs, and in fact comes off the back of last year, which was also quite light and about 30% down on the year prior to that. We were reasonably fortunate in that last year we were very active. So for various reasons, quite a few funds were cautious and had pulled back from the market last year, so 2023. And we added 7 new names to our portfolio and accounted for about 10% of the new investment activity of the VCT sector. So that put us into a really good position coming into this year, that we weren't needing to find deployment for deployment's sake. So we've been reasonably cautious, because actually what we've seen this year is there's not been that much out that has been great, and what there has gone at very high valuations. So we've fortunately been able to sort of hold back from that a little and really pick and choose where we invest, and to sort of pick up on your earlier question, only invest where it's a really great fit for sort of us and how we work and how we can help.
Very good. So to sum up, Rupert, for those that want to back a VCT this year, why should they pick one of the Puma VCTs?
I think if people are looking for that sort of tighter portfolio with really strong heavy management from the VC manager, that is what we offer, and that if they're looking for that, I think they should consider us.
Rupert West of Puma Investments, thank you very much. If you're watching on YouTube, please press like and subscribe to the channel for more.